It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Well, welcome to Your Personal Bank Show. And I'll tell you what, for those of you that have not normally heard us, I've been on Tuesdays at noon for almost a year now. And Money Radio has been gracious to allow us to be on another slot. So we're here on Thursdays at 1 now. So we're on twice a week. And, of course, the show is replayed on the weekend. So pretty exciting. We've been having fun sharing this information about your personal bank and what it is. And I guess I should, those of you, if you're new, if you haven't heard us before, I'm going to encourage you to go to yourpersonalbank.com. And you can go online and listen to any of the previously recorded shows to kind of get up to speed on what this is all about. Those who have been listening regularly on Tuesdays, you know, they've got a head start on you on the Thursday, folks, if you know what I mean. Now, if you're some of the same people, welcome. Great to have you here, too. I guess I'll share with you this. First of all, you know, what is your personal bank and who am I and my background a little bit, and I'll share with you, and then we'll kind of get into it further. But what your personal bank is it's quite simple. It's a financial concept that combines specific tools from both the banking and insurance industries to create growth on funds, even when you're using those monies for other purposes. And really what it's called is positive arbitrage. Folks in, a lot of business owners, the real estate investment world are very familiar with positive arbitrage. They'll use dollars or borrow dollars at a lesser rate, to leverage and create wealth strategically. Okay, that's a common thing. We show folks how to do that individually and through their business, okay, with guarantees and safety involved. So the underlying asset doesn't lose value, so you don't have to worry about things going wrong with the positive arbitrage, which is some of the risks that can happen. So we take that off the table. It's really cool how it works. I'm going to go into it a little bit further how this works, but before I do, I want to share why I share this. I've been in the financial industry 22 years. Even before that, I've been an entrepreneur for even longer than that. And, I've owned a retail business. I've owned a service company, a contracting company. I own the financial agency the last 16 years, actually. And I'm also chairman of the board of a bank in formation. We were in the process of actually submitting our FDIC charter in March. And, of course, with COVID, everything kind of got out of whack. And, of course, we're put on, all this is put on hold indefinitely but I'm in the process of trying to start a bank or open a bank. So when I took the entrepreneurial background that I've had for now over 25 years experience, along with the financial background, and then the banking experience, one thing I've learned about getting into the banking world is there's very little cross-pollination between the financial world and the banking world. It was surprising to me. There's very few people out there that have a good understanding of both. And so that's where that was this whole idea of your personal bank was born. And there's some people that talk about, I talk to occasionally. Most people have not been familiar with this concept, but a few have. And the ones that have the insurance banking concept, they maybe is a term that's often used. It's known by different names. But we've taken it to another level. And what I mean by that is bringing in the bank tool. And again, I was able to do that because of the bank contacts that I have. It wasn't easy. This is a very specialized area of lending. Okay, so you can't just go down to your local bank and get this done. I literally know of a handful of banks that do this around the country. But anyway, how this works, it's really quite simple. And by the way, if you want more information on me and check out my bio and that kind of stuff, go to yourpersonalbank.com. I encourage you to do so. Contact us. I'll be happy to reach out to you. Be talking to me, okay, if you'd like. I have a number of advisors with our agency that work with me also. But if you want to talk to me, feel free to ask, and I'll be happy to do so. But anyway, what your personal bank is really this simple. Again, the first step is we're setting up a high cash value policy that's designed to maximize cash growth on a tax-favored basis. Now, here's the thing. This is not the insurance policy most people are familiar with, okay? Vast majority of people I talk to, I do workshops. I've been speaking around the country up until COVID happened to investor groups literally all around the country for the last 5 or 6 years. And I would ask the question, I would have fun with this. I'd say, how many people in the room have life insurance? And, I get half to 2/3 of the hands typically raised. And I'd look at them all, and, I'd say, no, you don't. And a lot of people kind of look at me funny. Some get confused. And I even had a few kind of start to argue with me a little bit. No, you don't have life insurance. What you have is death benefit protection. And then the light bulb started to come on. Now, I'm not saying death benefit protection is a bad thing. One of the things you're going to learn about me if you listen is one of my pet peeves is, in my opinion, there's no such thing as a bad financial tool. There are a lot of bad financial fits. I see it all the time where somebody is in something it's not a good fit for them. That I see all the time. But the tools are agnostic. They're designed for certain specific jobs, and they will accomplish certain things. And so if somebody's out there making blanket statements, I'm going to just tell you straight up, if somebody makes a blanket statement that this product's bad or that product's bad, all they're doing is sharing their personal bias. And as I teach my agents, as I train them and work with them, is, look, it's not supposed to be about your personal bias. It's supposed to be about your client's needs and their goals. So stop knocking certain things off the table just because you don't personally like them. And so, my recommendation, my opinion, if somebody makes a blanket statement that this is bad or that is bad, find a different advisor or listen to somebody else. Here's the thing. This tool has a very specific purpose that benefits an awful lot of people. And it has actually multiple purposes. Again, because we're strategically combining an insurance tool with a bank tool. I'll bring the bank tool in a minute. I want to finish the thought on the insurance tool. Again, this is not something most people are familiar with. Most people think of insurance, they think of it, okay, what's the least amount of money I can pay to get the biggest death benefit? Right? That's what we do. And that's a death benefit protection tool. And again, as I stated earlier, that is not a bad thing. I have a family. I have kids. I have a business. I have death benefit protection, and I'm the breadwinner of the family. So I have death benefit protection needs. And I've taken care of those needs. So if something, God forbid, happened to me, my family, the loved ones are taken care of. And here's what I want to say to you. If you have those types of situations, or you have a business, or you have a key person scenario or whatever, you should take care of those needs. Okay? That's just needs to be done, right? It's one of those things. But that's not what I'm talking about here today. And by the way, if you have those needs, can we take care of it? Sure. We do a lot of things. Don't get me wrong. My focus here today is on the personal bank concept. I want you to understand when we talk to folks, there's a lot of business planning, succession planning that happens, tax planning. We have strategic partners, attorneys, CPAs that we work with, financial plan. There's all kinds of different things that go into retirement. Okay, we look at all those things. Don't get me wrong. But I share the personal bank concept because I find, in general, the knowledge level, the experience, the amount of that people know about it is so limited, almost in many cases just unheard of. It's not uncommon for me to have a workshop, like I said, up until recently, 100 people in the room, and I'll ask how many people, prior to meeting me, had been introduced to or had any introduction or knowledge about the personal bank concept or the insurance banking concept or whatever you want to call it. 2 or 3 hands typically will go up. That's it. So from my informal surveys, and this is over a number of years of speaking around the country to investor groups, these are people that are knowledgeable. These are people that are actively learning about money. Okay, this isn't the general public. The general public, the percentages I'm sure are much worse. But these are among people who are actively looking to learn more about money. And I typically find 2 to 3% of them have even been introduced to the idea. That's how few people really understand what this is and what it does. So I'm going to encourage you to stay tuned in the next segment because I'm going to go into further about how we strategically integrate the insurance tool with the banking tool to create positive arbitrage and earn interest on money you spend. Stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. And again, if you're new to us, this show on Thursdays, hey, welcome. We've been on Tuesdays at noon for about a year. And we've now added another time slot. We'll see how it goes, but pretty exciting to share this with hopefully some new folks. If you've already heard us on Tuesdays, welcome. Your Personal Bank, what is it? Again, it's a financial concept combining a banking tool with an insurance tool to create positive arbitrage on money you've spent. Now that's a mouthful. I'm going to explain to that further why and how this works and why this could benefit you and in a number of situations, whether individually or with your business. Like I said, the first step we do is we set up a high cash value policy. Again, this is not the type of insurance policy most people are familiar with. This is designed to maximize cash growth and minimize the death benefit. This is completely the opposite of what most people use insurance for. Most people use insurance as a financial, or as I should say, a death benefit protection tool. This has that, but that's the secondary importance. Primarily, we're maximizing cash, okay? It's like a teeter-totter. If you think, I always share when I do a workshop or individual meet with somebody, I show a teeter-totter in my PowerPoint where I show the difference. And if you want to vision a teeter-totter, putting the death benefit on one side and the cash on the other, we're flipping it on the opposite of what is normal, okay? Happens to grow tax deferred, so we got some benefits here tax-wise, okay? That's really cool. Now, it's highly liquid. Depending on the situation and how we structure them, we usually see about 60 to 90% cash available day one. That's huge. By the way, for those of you who have been introduced to this concept, like I said, overwhelmingly, it's very few, but those that have, if you're not sure if you have one designed to maximize cash growth, look at it. I'll give you a couple quick pointers. It's real simple. If less than half of your contribution is available day one, it's not structured correctly to maximize cash growth. Okay? Happy to compare that, do an apples-to-apples comparison, and show you significantly more cash growth. I did that for a gentleman, in fact, I met with this past week, had some contracts, cash growth policies, designed to grow cash, as he thought, for the last decade. This was a very well-known, very reputable company. The problem was, when it was the way it was structured, was not designed as efficiently to maximize cash growth as it could have been. We're actually converting those, doing a 1035 exchange. It's a non-taxable event. And we're showing him at retirement about 20% more cash than he would have otherwise. And in his case, it's several $100,000 difference. So that's the point. And he set those up 10 years ago. If he had set them up 5 years ago or 2 or 3 years ago, the difference would have been even greater. Okay? So my point is, as I stated to him, look, with these contracts policies you had set up 10 years ago, think about it a minute. They've had 10 years to run a race. They've done 10 laps already, and we are just starting out. Yet, within a few laps, we catch up and then bypass your current cash growth. And eventually, later on, before you retire even, we lap it. I mean, we just do there's a whole heck of a lot more cash is what it boils down to. So made a ton of sense for him. So he's, moving forward. But here's my point. It's designed to grow cash. Okay. That's what I want you to understand on a tax favor basis. Now, the second step is simple. We've identified and we now work with several banks. There's only a handful around the country that do this, but they'll offer a line of credit against using the policy as collateral. The cash value of the policy is collateral. This is not unlike a HELOC or home equity line of credit. Most people are familiar with those. Okay, a HELOC basically is designed. You get a line of credit against the equity of a property, right? The advantages of these kinds of loans, these line of credits, is there's no loan fees. You're only charged interest on the funds when you actually use them. And also the rates are usually very favorable. They're very low because it's a collateralized loan. In other words, if the bank doesn't get paid interest, guess what? They know the money's there. They're going to, they'll take it, right? Now, the benefit here is over HELOCs or this. The bank line of credit, it's the collateral or the policy I mentioned earlier. And again, if you didn't listen to, I recommend going back to Tuesday's show, go to yourpersonalbank.com, and I shared quite a bit about the different options on the growth options. I'll just hit on it real fast. We have the steady consistent that's currently paying 6.1%. And we've got companies that have been paying 6% or more since 1996 every year and have never missed a dividend in over 100 years. In fact, some of them since before the Civil War. In other words, they've been paying dividends through all this time, including the Great Depression, without skipping a beat. So if you want steady, consistent dividends, interest, folks, this is worth looking at. And I think I said for Tuesday's show, I get a chuckle a little bit when people are looking at dividend-paying stocks and things like that. I'm not saying those are bad. Don't get me wrong. But if you're looking for long-term, consistent, steady dividends, this is hard to beat. Again, company's been doing this for over a century, okay? Even longer than that. But my point is you can get 6% steady, consistent growth today. That's pretty good. We have index options if you want some more potential upside, where literally you'll earn between 1, that's the floor, and 14% per year. That's the cap. So between 1 and 14 based on the S&P 500. So whatever the S&P 500 does that year, you're going to get what it gets between 1 and 14. So if it goes up more than 14, you get 14. If it goes down, you still get 1. So, for a lot of folks, that's pretty nice. I have never had somebody get upset with me because the S&P went up 18 or 20% in a year and they only got 14. Okay. Just don't, but they love it when the S&P goes down and they don't lose any. So again, there's your trade-off, right? There's your strengths, there's your limitations. That like with any financial tool, all right? There it is. It's that simple. Some people try to make it more complicated than that. It's not, folks. If you want something where you can get in the index, earn what the S&P 500 does, and you're going to earn between 1 and 14% per year, we have that solution. By the way, we can do the bank line of credit and access funds against it at 3%. So if you make more than 3, you're still making money. You're making money on money you spent. Okay, I'm going to go into that a little further. And the third option I mentioned, the steady 6.1, there's the index option 1 to 14, and then the third one is the performance factor. That it's enhancement. It's a performance factor that gives you 2.7 times, 2.7-fold return on the index. So let's use the S&P again. There's other options available. Let's say your S&P goes up 10% that year. You get credited 27%, folks. There's a 7.5% fee on it, so they would take that off, but you still double the index, basically. So in good market years, you can double what the index returns are. Guess what? On the downside, down years, they guarantee the principal. You still have the 7.5% fee, so your worst case scenario is you lose 7.5%. That's your floor. And by the way, it's also you also have tax benefits. It's tax deferred, okay? So if that's of interest to you, or any of the combination of all three, we can do that. 6% consistent, 1 to 14 index, or performance factor, double the returns in good years, 7.5% loss in bad years. That's a range. And like I said, I like sharing things like that and giving people, here's the strengths, here's the limitations of each of the options. Which of these makes sense for you? Let's forget all the noise out there. Let's look at the facts. Let's use a little bit of common sense. I guess a former mentor of mine used to say, he was famous for saying, common sense is uncommon. These last few months this year, it sure seems like that's really the case. I mean, who would ever thought, I said this Tuesday, who would have ever thought wearing a mask or not wearing a mask would be a political statement? I mean, where did that come from? You know what I'm saying? Our world has gone topsy-turvy, okay? And it's crazy times we live in. So some certainty, some guarantees with your money is not a bad idea to look at. I don't think anyone can really tell us where the markets, where our economy, or anything else is going to be next week, next month, next year. I don't think anybody really knows. So having some certainty, I'm not saying everything, but having some certainty and having some diversification, having some guarantees, having some tax benefits just makes a lot of sense. It makes a lot of common sense. Okay? So look at it. I'm not begging anybody. I've never been busier in my career. I've been doing this for 22 years. For your sake, look at it and consider it. Stay tuned, because in the next segment, I'm going to talk about how the bank piece, the bank line of credit, creates the positive arbitrage so you can earn interest on money you spent. Stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back, and I'll tell you what, we're having fun today. We're talking about your personal bank and positive arbitrage. And those of you, again, that are new on Thursday, a new time slot for us. We've been on Tuesdays at noon for almost a year now here on Money Radio. And to be on this new time slot, it's a blessing. It's a pleasure and a blessing. So I'm really excited. Hopefully, meet some new folks this way, get some information out. And I have a lot of passion for this, if you can't tell. And my background, like I said, I'm an entrepreneur at heart. I've owned actually a retail business. I've owned a service company, a contracting company. Last 16 years, I've owned the financial agency, and a couple of years ago, I'm chairman of the board of a bank in formation. We were in the process of opening an FDIC insured bank. Of course, COVID kind of put a hold on everything, so we're just going to kind of wait for all this to blow over. But hopefully, we'll get a bank opened soon. We'll see. Anyway, I think we will. But anyway, I share this personal bank concept, and we do a lot of financial stuff. We do the retirement plan. We do all these different things that a lot of folks do, but this is a unique niche that I have found has benefited so many people, and the amount of knowledge and information about it is so limited. And again, this is based on my experience working with hundreds. We've set up hundreds of these over the last 7 years. I've spoken around the country to investor groups over the last 5 or 6 years. I've been in front of several thousand people now in the last 7 years, and I find when I ask the question, how many have been introduced to this concept, I get 2 or 3% typically response. I have 100 investors in a room. And again, these are people that are thinking about and actively wanting to learn more about money. So you can imagine the general public, the knowledge level is even much less than that. But amongst people who are actively wanting to learn more about money, folks that are willing to attend a half-day workshop, for example, I'll ask them, and 2 or 3% have even been introduced to the idea. I'm talking about advisors, I'm talking about investors, I'm talking about individuals, business owners, you name it, across the board, it doesn't seem to matter. The amount of knowledge out there just isn't there. So that's why I'm doing the show. That's where my passion comes from. And like I said, I've even said we've even set up a private Facebook group for our folks who have personal banks or are seriously looking into them. I'm in contact with these people on a daily basis. And the changes to lives this makes financially, it just, it fires me up. What can I say? I get excited about it. So some people say, well, you should be more calm and, more dour, I guess is a good word. I don't know. That's just not who I am. That's not my personality. When I see something that I have passion for it, okay? I've been doing this for 22 years. I still have passion. I love what I do. I've never been busier in my career. So, what can I say? And I love what I do. So I guess it's a win. But I said, people, you should take a look at this. This isn't for me. Like I said, I've never been busier. This is for you. That you should consider it, seriously look into this and consider it. And here's why. What is your personal bank? It's just as simple. Again, we're combining, if you didn't hear before, but I'll say it again, if we're combining the financial tool of a bank tool with an insurance tool to create positive arbitrage so you can earn interest on money that you spend. This is huge. This makes a big difference in many people's lives financially. Here's why. Here's how it works. Again, first we set up an insurance contract designed to maximize cash growth, not designed to maximize death benefit. There is one, but that's not its goal. That's not its main purpose. And it's the opposite of what most people think about for insurance. Flip everything you know about insurance for the most part, flip it on a dime. It's the complete opposite. We're designed to maximize cash growth on a tax-favored basis. So there's some tax benefits involved here, which is really nice. We typically have a high liquidity of 60 to 90% liquid day one, depending on how it's structured, okay? And we get up to 100% liquidity within a few years, okay, in most cases. Now, the second step is we have a bank, and again, this is a very specific, specialized area of lending. We can recommend the best rates with the banks. Not any bank does this. Most don't. But using a bank line of credit, the policy, the cash in the policy is the collateral for the line. Now, why do we do this and why is this important? Well, here's why. It's quite simple. We have several options on the policies in terms of how the money can grow. There's a steady Eddie consistent option. There's an index option. There's a performance factor option. The steady Eddie consistent right now, 6.1%. It's been paying. We have companies who have been paying 6% dividends every year since 1996 or better, 6% or higher, and consistently paying those dividends for over 100 years, some as long as before the Civil War, okay? These are long-term consistent dividend payers, okay? I can show you the charts. Contact us, yourpersonalbank.com. I can show you and help you identify which companies out there have that long-term history of paying dividends and plan to and intend to and have the financial resources to continue to do so ongoing. So they're paying 6.1 right now. Depending on how much money we're dealing with, the lines of credits are between 3 and 3.95%. It's real simple. If your money's growing at 6 and you access it at 3, what's your money doing? Still growing. What did you do with the money? In most cases, we have folks do things like pay off debt or pay ongoing long-term bills like car loans, credit cards, mortgages, whatever. Or maybe they're investing in their business or other assets. Why is this so important? Well, if you're a lot of folks with Money Radio, let's face it, a lot of your investors. What if you had a 2 to 3% return on your investments by flowing it through the personal bank? Would that improve your return, your ROI, return on investment? Of course it would. That's my point. I do it with business owners, real estate investors, market investors, crypto investors. You name it. I have all those types of folks as clients because it works on all those different scenarios. So how about, again, adding 2-3% on money you allocate elsewhere, whether it's to pay bills, expenses, debt, whatever, or to invest to make more. Add 2 or 3% return. Now, 2 or 3% might not be a big deal in 1 or 2 years for a lot of people, some people, but do that compounding over time. Do it over a decade or 2 or 3. Now we're talking about huge differences. And I'm not even talking about compounding because that comes into play, of course, too. This is why this is such a powerful tool and why it changes financial lives. And I know this for a fact because I told you I've worked with hundreds and hundreds of clients. We have a private Facebook page for folks that are using this on a regular basis that talk about how it has changed their lives. I see financial statements and tax returns on reviews with folks that I've worked with over time. We see the difference, okay? I'm there with them through the process. So that's where the passion and excitement comes from, because it's not just about rate of return on your investments. Understood. That's important. I'm not arguing that point. But it's more than that. Financial success comes about in terms of how much do you earn or grow in combination with how much expenses or outgo. It's the inflow minus the outflow. It's the difference. That's the key. That's what you have left to live on. And that's how you can help ensure you don't run out of money in retirement, for example. If you are getting a 2 or 3% return on your outflow, that means you have more money over time, and it'll last longer. One of the number one fears of retirees, running out of money in retirement, right? I mean, I think most people understand that. This helps offset that and encourage and ensure that money lasts longer. The money goes farther. I use examples in the Tuesday show about folks using, they just refied their home, and they got a 3.2% interest rate on a 30-year fixed mortgage. And then they're going to flow. They have some assets and accounts elsewhere. They're funding into this. They weren't happy with what was going on there. Funded it here. And then using the bank line of credit, accessing the funds, getting a 3.1% positive arbitrage on those dollars, and using those dollars to pay the mortgage, which is costing 3.25%. But they're earning 3.1 on the money they're using to pay the mortgage. So their net result is their total result is 0.2%. Cost. That's a really good rate. I think everyone would agree. Those are some of the ways that we use your personal bank to ensure people have more money to live on, make sure their money lasts longer, and pay less taxes. Stay tuned to the last segment. We'll talk a little bit more about this and how this can make a difference for your life.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ferenc Toth.
All right, we're rounding third, and I just want to say one last time, welcome, folks, to Thursday, folks. If you haven't heard our show, we've been on Tuesdays at noon for about a year, and we've got added another time slot, so it's really cool. Anyway, the Your Personal Bank concept, if you haven't heard the previous segments, I'm going to really encourage you to go to yourpersonalbank.com, listen to the previous part of this show or any of our previous shows to learn more about how this tool, this concept works. And again, really what it is, it's that simple. It's a financial concept where we're using a banking tool with an insurance tool combined to create positive arbitrage on dollars even after you spend them. There's 3 different ways the money will grow. Fixed. We have a fixed option, a steady, consistent option, if you will, earning 6.1 right now. Historically, he's paid more than 6 over the last 25 years. Never missed a dividend in these companies, over 100, some before the Civil War even. These are long-term dividend payers. And then we can show you the information. Again, contact us at yourpersonalbank.com. We'll show you the charts. I'll show you all the different companies, and we work with all of them. We're independent. We can work with just about anybody. So that's also kind of a unique thing. And I'll show you all the different ones. It's not that this company's better than that one. It's better because of this reason. We're agnostic about which companies we work with. We really want to find the one that fits the client the best and does the job, okay? We have index options where basically it's based on the S&P 500 index. You're going to make from 1 to 14%, the floor of 1, cap of 14, depending on what the S&P does any given year. There's folks that love that. So if it makes more than 14, you make 14. If it goes down, you don't lose, and the principal is guaranteed. You still get 1. So it gives you some steady, some guarantee, some downside protection with some nice upside potential. By the way, the average returns on that, I can show you the information on that. Past 25 years, 8.52%. Is it going to happen in the future? I don't know. We can't tell. No one knows, obviously, right? But if it goes down, you don't lose. If it goes up, you can make up to 14%. Not a bad option. And then we have a performance factor for those that want to take on a little bit more risk but really have the upside potential, where it gives you a 2.7 time factor return on the index. For example, if you have a 10% return on the index, you're going to get 27% that year, minus the fee, which happens to be 7.5. It's tell you right up front. So your return that year is 19.5. The index did 10. So what did you do? You effectively doubled the returns on the index in a good year. In a bad year, principal is guaranteed, still have the fee, so you have the 7.5% as the floor. That's the worst case scenario. So if you're good with, hey, I can double returns on good years, 7.5% loss on bad years, that's a good fit. With tax benefits, there you go. We can do any one of those or a combination thereof. But the key is, the last piece is, it isn't just about return and growth, okay? This is one of the things I teach people from a financial literacy standpoint all the time. Building wealth is a combination of growth or income minus expenses. It's the difference. It's what's left. That's how you build wealth. You have the bigger that gap, the more wealth you can create. Okay? So one of the things that's very infrequently looked at, and we look at this all the time, is what is the expenses, what is the outgo, and how can we benefit from that? This is where your personal bank you can get some nice growth, steady, consistent, or index or performance factor, but it also can benefit you on the expense side. And how we do it, again, is using the bank line of credit. The bank line of credit, the collateral for the line, is the cash in the policy. Okay? So it doesn't affect other financing options or anything like that. Okay? There's no fees, loan fees. You only get charged interest when you use it. And the current loan rates are 3 to 3.95, depending on how much we're talking about. We can go with as little as $20,000. If you're over $60,000, we can get you 3%. Okay? I mean, that's just how it works. And there's fixed options too, by the way, on the bank line of credit, just so you know. So the bottom line is we can lock in a 2 to 3% positive arbitrage situation for you. Now, why is this so important? Well, most of us have bills, right? Many of us have debts. Some of us have, we have expenses. Pretty much all of us have expenses. Money's going in, money comes in, money goes out. Well, on the part that the money goes out on, what if you could pick up 2 or 3% interest on that money? I've been doing this, I just did this week for a business and for a couple with a mortgage, okay? By picking up that 3%, in both of those cases, they were able to pick up 3.1% positive arbitrage. The couple, their mortgage was 3.25, 30-year fixed, just refied. That means their net cost of their mortgage loan interest is about 0.2 because they're making 3.1 and they're getting charged their mortgage was 3.25, right? If you're using this to pay other bills or buy items, purchase items, okay, you could pay cash for something. You could finance something. If you finance it, you got to pay the interest. If you pay cash, you give up those dollars to earn interest or gains, right? Well, why not use this tool and pick up 2 or 3% interest and buy that car, for example, or other big ticket item? Or if you're an investor, you want to invest in something, whether it's be the market, real estate, cryptos, precious metals. I'm agnostic. What is your thing? What is it that you like to invest in? Okay, if you have something that you like, I'm not the one that's going to tell you not to do it. If it works, you like it, and it works for you, I'm going to tell you to keep doing what works and what you are inclined to do. All I'm going to recommend you to do is do it more efficiently. You could keep investing in those things, whatever that investment may be. But what if you could pick up 2 or 3% more return on that investment? If your average annual return is 7%, for example, why not add 2 or 3 to that? Why not make it 9 or 10? You see where I'm coming from. You can take dollars and invest in whatever that asset is, whatever that investment is, and you can get the return. Or you can flow it through the personal bank, put it into the policy, borrow it from the bank line of credit, pick up 2-3% interest, positive arbitrage, and invest in that asset, whatever that is. Add 2 or 3% to it. Would that make a difference on your return on investment, your ROI? And I would venture to say in most cases, and by the way, this is based on 22 years experience of working with clients, the answer is absolutely yes in most cases. Makes a big difference. An additional 2 or 3% return ROI on any asset or investment you're doing over time can build up to be a tremendous difference. If it was just 10 years, you're talking 20, 30% more. Okay, that's the difference. That's what we're talking about. And that's why I get passionate and excited about really making a difference in people's lives. I guess that's what my wife, when I come home from, used to, now I work from home mostly, online, of course, but she would say, I can tell you've had a good day. I said, yeah, I met with somebody. I was able to make a difference. The light bulb came on. They understood. And now they're going to implement this. And I know what it's going to do for them down the road. And that's what I get excited about. That's where my passion is. That's where my motivation is. And why, after 22 years of being in the financial industry, and longer than that as an entrepreneur, why I still have the passion I do, and why I still love what I do, and why I'm doing the radio show. Because I've said this earlier in the show, I have never been busier in my career. This isn't about me needing to talk to more people. This is about you and making a difference in your life. So I look forward to talking to you. We'll be on next Thursday at 1 o'clock. Stay tuned, or you can also tune in to us at noon on Tuesdays, or go listen to the show anytime you want to yourpersonalbank.com and listen to any of the previous shows. Contact us for more information. I'd love to talk to you and show you and share with you how this tool can change your financial future. Talk to you soon.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.